Well, tonight we'll be drawing information from what factors drive analysts' forecasts. That was a paper written for the Financial Analyst Journal, as well as James Montier's memorable 7 Sins of Fund Management. Roland, let's start off with you. Let's talk about forecasts, and I suppose this might be pretty much a simple question, but why are forecasts so important and what role do they play?
Well, I guess the industry is trying to anticipate what's going to happen in markets so that investors and economists can actually plan ahead, if that's the right word. Making forecasts is incredibly difficult. I guess we could say that if we knew what was going to happen in the future, the last thing we'd want to do is tell somebody about it, right? We'd want to keep that to ourselves. So there's a lot of noise in data, and therefore forecasting is very difficult. And there are certain models that can help one create some kind of foundation. But it's not an easy game, and the evidence is not very in favor of the accuracy of these forecasts.
So just looking at kind of macro forecasts, you've always got revisions to forecasts. I mean, this year, how many times have we seen GDP forecasts being revised downwards? What does that mean about how we trust, firstly, the macroeconomic data?
Well, you know, it's interesting that you mentioned that, because just this afternoon, I was actually sitting and actually reading an investment mandate. And when it gets to risk disclosures around an investment mandate, it says all factors considered are highly subjective. And this is when they're talking now specifically about fund managers trying to make decisions about what to include in a specific portfolio. And I mean, I find that quite interesting because, you know, we're dealing with a subjective matter. So therefore, we try and apply mathematical tools and we try and apply logic to this. But quite frankly, there's a whole bunch of extra factors on the outside that kind of impact on this. And that makes a huge difference.
Hard to quantify and hard to predict how all those moving factors are going to eventually come out in an outcome.
Yeah, no, absolutely. And as a matter of fact, if we actually look at the work that's been done about this and about looking at analysts and economists and anybody trying to forecast markets, it'll be quite interesting to actually see as how good and accurate people actually are at this. As a matter of fact, we've got some data that we'd like to show you. And if you look on your screen right now, you will see some work done by the Federal Reserve, the Bank of Philadelphia. And you're looking at data here. You're looking from an economist perspective. You're looking at real GDP growth, year-on-year changes. That's in the blue line relative to actual consensus forecast. And you can see consensus forecast is, quite frankly, always kind of somewhere around the median, which is fantastic, but they don't ever get the points right, which means that it's probably pretty difficult to forecast these kind of markets. Another one to show is this is out of James Montier's work. This is 7 Sins of Fund Management, and as a matter of fact, we've actually showed you some of that data here on the show in previous shows. But here you can see 10-year bond yields, and that's in the static, or what I show the non-colored line, relative to forecast, which is in the dotted line. And look how different forecasts are from actual 10-year bond yields, and that just shows you over time how those look. And as a matter of fact, if we apply that to the S&P 500, and these are just S&P 500 forecasts now, again, you can see how different those are. These are the actual returns for the S&P 500 in the black line relative to the actual forecasts that happen.
It looks like there's a lag
in the other lines. Yeah, I mean, I'd agree with that. You know, there's this lag effect that happens. And
so
I mean,
it's saying people react rather than actually anticipate what's going to happen.
Yeah, and maybe there's a sentiment factor here that needs to be taken into consideration.
I mean, it's almost like the ratings agencies, how they've been criticized is that they're always acting after the case. So what does this mean about how much we mistrust then forecasts, if from a macro level and then also from an equity and an asset level, they're not getting forecast spot on?
Well, I think the first thing that you need to consider is how analysts are remunerated. So you get 2 types of analysts, I think, in the market. The first is a sell-side analyst, and the other one is a buy-side analyst. A buy-side analyst, quite frankly, is somebody that works for an asset manager, and a sell-side analyst is somebody that lives and dies by their actual forecast. That means they're actually working for a brokerage house. Now, both of those analysts would potentially be remunerated in slightly different ways. So the sell-side analyst is somebody that is predominantly driven by bonuses. It's predominantly somebody that wants to earn a higher bonus. Now, if you're a bearer of bad news, quite frankly, that doesn't necessarily go down very well. So when something invariably does happen in the market, sell-side analysts often find themselves maybe on the wrong side of that. Because, you know, how are you going to earn a bonus if you, quite frankly, tell people that don't buy a share? You know, don't buy the share that I'm following, because, you know, how will you make money out of that? Whereas on the buy side, for me, there's something slightly different that happens. Here they're looking at it specifically from trying to include it in a portfolio, and they're looking at the merits of a specific company relative to other companies. So therefore, kind of looking at both maybe becomes important.
So do we trust buy-side analysts' forecasts more then? Is that what you're trying to say?
Well, this study that Kirby actually mentioned showed that sell-side analysts, on average, are slightly more accurate in their forecasts. I guess it's they have more time because on the buy side or on the asset management side, people are managing money, which requires a lot of other things that you've got to do in terms of risk reporting and feedback to clients. So I guess sell-side analysts also have maybe better access to management because they look at the company and make recommendations on the company specifically, so they might have an information access advantage rather than any kind of additional non-public kind of information. But I think we must understand that analysts are not just paid to make forecasts, and economists are not just paid to make forecasts. That is one.
You also have to know who they're working for, because there's been a lot of issues about economists perhaps skewing out the data to make a case for an investment in some way.
I mean, look, good research should be independent as possible. But I think it's important to understand that forecasting is the hardest part of any analyst or economist's job. The other things that they have to do is look at, for example, the equity analysts would look at the company's quality of management, the strategic direction of the company. Those kind of criteria are probably just as important as having a forecast. Forecasting is noisy and therefore very difficult, but there are other things that these analysts do and economists do as well. So if you want to know what impact inflation is going to have on GDP, you have to go to an economist. They might be wrong, but who else are you going to go to, right?
I suppose maybe the trick is then to look at where the bias is. Is there bias towards the downside or the upside? What is the trend in the data? Is it more likely that the stock price is going to fall than actually increase? And that's what forecasts can tell us.
Well, I mean, I think the thing to take into consideration is that when you look at analysts, often there's herd behavior amongst analysts. So if you look at, for instance, people that come up with a buy signal or a sell signal for a specific business, you usually see herd behavior around it. And I mean, it's well documented. If you go back and you look at the American market, you look at how many people actually came up, or how many analysts actually came up with the demise of some of the very large names in America, American corporate history failure.
Lehman's, obviously.
There's a classic example. But think about it from that perspective. If you had to come up with a sell signal, and you were the outsider from an analytical perspective in America, in the American analyst community, who would take you seriously? Would somebody say to you, look, you know what, you've got a point here. I see what you're saying. And hence, you see this herd behavior. So when everybody says, look, it's a buy or it's a hold, that's generally where the group kind of sits. As a matter of fact, I want to show you a graph that we've put together. And what you see here is HSB analyst forecast. And it's quite interesting to look at this graph because it shows you global analysts and what they suggest about HSBC right now. It also shows you a number from last year. So how many people actually thought, and percentage of analysts actually thought that you should own it, and how many people thought that you shouldn't own it. Look how few people actually think that you should be selling HSBC. And I'd like to show you another example, not to pick on HSBC. Let me show you Apple. Here's a business that have been compounding earnings out for at least a couple of years, and it's done very, very well. Look how many analysts are coming up with buy forecasts for this, or outperform forecast for this specific stock relative to people who says you should sell the stock. Well, very, very few. As a matter of fact, if you go and you run a global ranking system, you just look at how many analysts are coming up with a sell signal for specific stocks. I mean, you find very, very, very few of them. And they are predominantly companies in emerging markets and out on the fringes. Because again, if you are a technology analyst and you're coming up with a sell signal for Apple at the moment, I mean, you can't be popular for doing something like that. And you have to take that into consideration.
So if that is the case, I mean, I don't know, Roland, what's your experience with this? Should we be paying more attention to the outliers?
There are two things here. The first thing is that there are behavioral biases, which is sort of what Kirby was referring to. So analysts, for psychological reasons, don't want to go underweight the sector that they cover, because then people don't really want to listen to them. The second thing is that if you change your forecast, you want to change it only you're sort of admitting defeat. In other words, if you are wrong, you're reluctant to change the forecast. So you delay it. And that's why we see these lag effects happening in the data, where analysts, despite new information,
do they want more evidence?
They want more evidence to prove themselves wrong, and that's also tough to do as a human being. But the real value in forecasts is actually not the level. In other words, if they say the rand is going to be here, that's not really the issue. Where there's a lot of useful information is what we call earnings surprises, or where a company announces and everyone got it wrong. Like the recent interest rate cut we had, nobody was expecting that. That tends to have market moving kind of effects. But you'll only know if it's a surprise if you actually have a consensus forecast. So it's not the level that matters, but the actual unexpectedness to that expectation.
Earnings come out, beat forecasts, likely that the stock is going to rally.
Well, I mean, I would say that the best asset manager out there, the best people in the business, are people that can look at the trend, understand what the business does, and then can, if it's priced for perfection, rather sit back and say, look, I'm not prepared to own it, at these kind of prices. I'll wait, regardless of what the forecast is saying. Regardless if the forecast says that earnings can increase even by another 20%. They ignore all of that. They say, what's the trend line over here? What do we think about this, and what am I paying for it? And quite frankly, am I prepared to sit on the sideline and wait? And very often, it sometimes helps to kind of sit on the sideline. I mean, again, this paper that we're discussing today, What Factors Drive Analyst Forecast, they look at 2,500 analysts globally, and they look specifically at how they analyze different companies, and they try and find where the biggest correlations are between the different groups. And I mean, there's two areas that stand out immediately among sell-side analysts predominantly, and that is revenue growth and balance sheet strength. That is kind of where you see the largest correlation of what they think might happen. And again, there you see the herd behavior. You see people kind of clumping together and saying, well, quite frankly, we'll act as a group rather than trying to act, And
interesting, they also analyze consistency amongst analysts with regards to analysts who look at the same companies, and where they saw the highest consistency in terms of ratings was with regards to revenue, balance sheet strength, strategy, execution, and communication, and least consistency, meaning they've got divergent views with regards to stock price performance, industry competitiveness, and low price strategy. So I mean, a stock price performance, that's a big one, because if they're saying the stock is going to go up and someone's saying it's going to go down and no one can come to an agreement,
but who do we trust? If you're doing it from an international perspective, you're looking at it from a quarter-to-quarter perspective. And quite frankly, the biggest driver in the short term of share prices is sentiment. The biggest driver long-term of stock prices should be earnings. But that's over the very long term. So if you're just looking at it over this very, very short period, quite frankly, sentiment can drive stock prices anywhere. And it's classically what happens in South African markets, it's classically what happens in any market globally. And it's very, very difficult to kind of trust forecasts in those kind of markets. The other thing to consider as well is that you're living within a very large economic cycle on a continuous basis. And quite frankly, there's certain emotions that go with different cycles as the economic cycle kind of plays itself out. And as this happens, as these emotions kind of come to the foreground, it kind of clouds the way in which we feel about what we think of what the future might potentially hold. I mean, pre-2008, in 2007, the world was so rosy, anybody would have wanted to invest money. Today, you try and find people to buy equities. Very few actually want to buy equities.
When it comes to investing right now, what should be the key factors apart from analyst forecasts that we need to be taking into account?
Well, I mean, from my perspective, I think the first thing that investors need to understand is objectives, obviously. What is it you're trying to achieve? And then within the context of what you're trying to achieve, trying to buy those businesses that are mostly undervalued. Hence the value effect, what Roland will attest to, I'm sure, if we ask him. Talking about the value effect and trying to make sure that there's an evidence of that in the portfolio. And then quite frankly, holding on for the long term. Because quite frankly, the markets tomorrow can start rebounding. We just don't know what the future holds. And that's why it's always ensure that you kind of stay invested and make sure that you do so for the long term, rather than trying to worry about what a forecast is going to look for the next quarter or the next 6 months.
I mean, another issue that we need to bring into this forecasting discussion is one of environmental, social, and governance factors, ESG as they're calling it. Roland, what are the trends when we're seeing incorporating this into forecasts? Because these are primarily issues which are very hard to quantify. You don't know what the impact of a political coup is going to have on the business environment. You don't know what the impact of a potential, environmental legislation might have on your bottom line.
Absolutely. I think analysts are needing and are spending more time focusing on these kind of ESG issues. I don't think it's as high up their ranking in terms of importance as it might be. In fact, that paper that Kobe mentioned shows that it's probably the least important of the analysts' motivations to look at a company. But the clients, in terms of asset managers and pension funds and the end investor, are putting increasing pressure on the industry to actually make forecasts in this area. Trying to forecast the coup and these kind of things makes it even harder. So your error term in terms of forecasting becomes even more difficult when you add social and environmental issues to the picture.
Is they going to pay emerging market analysts a lot more than they should pay analysts?
Do they get paid more? Do they get paid more?
I don't know.
Just the hit that they have to
No,
take?
I suppose when you start looking at companies, I mean, there's people that obviously sit and focus on emerging markets, but often from an asset management perspective, the risk premium that they require to invest in any of those businesses obviously increase. The interesting thing for me is that over the last 2 years, you've actually started seeing people saying, well, look, you know what is a risk premium? Quite frankly, investing in Europe is as dicey as it could potentially be in Africa, so you may as well invest in Africa and at least get some higher yields as far as that's concerned.
Okay.
So it's quite interesting to see how our perceptions of what we think is risky and what is not risky has just been changed fundamentally by the sovereign issues in Europe.
Okay, wrapping this up, should we make decisions based on analyst stock forecast?
Forecasts only work in the very long run, and in the short term, you actually shouldn't look at forecasts. You should look at new tools such as sentiment indicators, and increasing the industry is focusing on these shorter term tools as well.
Same question for you, Kobie.
Good to know, bad to act on in the short term.